Okay, good afternoon, everyone. Thanks for joining us for another Lightspeed webinar. I'm Mike Sedek. I'm with Lightspeed, and I'm happy to have Evan Lazarus back with us today. Evan is the Chief Knowledge Officer at T3Live.com, and T3 Live is one of Lightspeed's premier educational partners. Evan's got a great presentation for us today on trading price gaps, and I think it's a really important lesson in the type of market that we're seeing now, where we have low volumes, and lower volatility. A lot of the trading opportunities that are presenting themselves happen during these gaps, so I think it's an important concept for traders to master. We are going to be recording this webinar. It's going to be uploaded to our website archive at lightspeed.com/webinars. So if there's anything you missed, you can always go back on there and view it at a later date. And of course, you can check out any of the other webinars that we have posted up there from the past. Just a quick mandatory disclosure that this webinar is for informational purposes only, so nothing that we talk about today should be construed as investment advice or any recommendations to buy stocks. I also want to mention that we are running a promotion for new accounts, so I see a lot of members of the audience today don't have accounts open with us yet, so we certainly encourage you to go to our website and check out the promotions that we're running. And if you have any questions about the presentation itself, please type them into the webinar chat box. What we're going to do is we're actually going to hold off until the end of the presentation to answer any of them. But if there's anything you want to ask, just type it in at any point. So without further delay, I'll turn the presentation over to Evan.
Thanks, Mike. I appreciate everybody taking the time out of their day to sit and listen, and I applaud the effort to, want to learn and further your education. And today's topic is a topic that is, I'm just going to say it flat out, up front, is very difficult. It is part of a class that I teach in the Active Trader program, which you can find out more information at T3Live.com, but it's in the advanced section of my Active Trader course. So there's a lot of information that we generally teach in, before we get to gaps and how to trade and interpret price gaps that really is a prereq for really mastering this concept or really sort of, wrapping your hands around it so it's as clear as day. Before I begin, I just want to, again, thank Mike for the opportunity and Lightspeed for this opportunity. I've been a Lightspeed trader. I've been using their software for years and years and years, and it's been nothing but unbelievable for me. And I have an entire trading firm that uses the platform as well. So if you're not on Lightspeed, you're probably doing yourself a disservice, and that's all I got to say about that. So let's get into it here. Here's our disclosures. Again, T3 Live is not a broker-dealer or an education firm, and this material is not offered, not a solicitation to buy or sell stocks. We're doing something new here at T3 Live, again, because we've done this before, and the request always comes in, well, can I get a copy of the presentation? If you text your name and email to the number you see on your screen, we will have it arranged so that you can receive a copy of this presentation when it's over, if you're not, if you don't view it again on the Lightspeed Trader website. A little bit about me before we start. I'm a managing partner in CKO. I possess all the knowledge here at T3 Live, as well as T3 Trading Group, which is our broker-dealer affiliated company. I've been a trader since basically 1998. I'm not sure how many years that is. I guess it's 12. 2012? A couple of years. I've traded through every cycle we've seen over this chaotic, last 10, 15-year period: bull market, bear market, internet bubble, internet bust, flash crash, you name it, I've been there. So my experience is pretty, is pretty deep, and I do trade every day. I'm not just an educator. I'm actually foremost a trader first, educator second. But what I do and how I trade solely, it depends, on what I know. For those of you that are familiar with me and have heard me talk before, have actually even worked with me, you know that the material that we lay out in the Active Trader program is, pretty much cut and dry, and how I approach, trading both on a short-term and a longer-term basis. So let's kind of just jump into it. We're going to start out with some basic information. What is a gap? How we define a gap? And again, as the presentation goes on, you'll see it gets a little more in depth and more granular. So basically, a gap is what we define as a difference between a closing price in one day and an opening price the next day. And as Mike said to start the presentation, gaps are a part of trading. Markets tend to gap up and markets tend to gap down, as do individual stocks. And it's something you have to understand because it does change. Sometimes a gap can change the course of direction of a stock, and sometimes a gap can continue the direction of a stock. So being able to analyze them and understand what type of gap you are witnessing can play into your decision-making process. As a trader, especially an active trader, whether you are a day trader, a swing trader, or somebody who lives in that short-term arena of time, whether it's intraday or multi-day, what you are essentially doing professionally, whether you are doing this as something on the side or something full-time, you are a risk analyst. I fancy myself not so much as a trader, but a risk analyst. My job is to identify pockets technically where I feel the risk-reward ratio is greatly skewed to the reward side with minimal amounts of risk. So that is what I do for a living. It's not so much I'm a trader and I buy and sell stock all day. The execution piece, buying and selling, is a byproduct of my ability to analyze and mitigate my risk. So we have two examples here, a gap up and a gap down. Gap down is basically when the open is below the prior day's close, and a gap up is when the open is above the prior day's close. It creates a gap in price. We call this circle, which you see on the screen, the gap. So what causes a gap? A gap can be caused by multiple things. And again, it's not necessarily as a technical trader. It's not our job to understand why the gap is happening. It's our job to evaluate how price reacts to whatever the driver is. Gaps can be caused by upgrades, downgrades, earnings reports, headlines. Many different things can cause gaps. As we say here at T3, the tip is not necessarily to know the exact reason why a gap's occurring, but the job is to be able to exploit high odds trading opportunities with gap strategies. And we're going to look at some examples of that, and we're also, if I have some time at the end, depending on how long this takes, we can look at some live, real-time, current examples. So there's three types of gaps. We classify them into three generalized types. We have one, the continuation gap, where gaps occur during and in the direction of an ongoing trend and are generally viewed as confirmation of the trend's strength. They typically bring in above average volume. A professional gap, which is also known as a reversal gap. Basically, gaps that occur as a reversal against the short-term trend, and they tend to deliver significant shock value. They can be so powerful that they may trap buyers or sellers to cause extreme emotions and reverse in the direction of the stock's short-term to intermediate-term trend. Again, I'm reading on the faster side only because the text is laid out for you to read. As we look at pictures, and again, the picture always will tell the story, this will become a little more obvious. And the novice gap, generally those occur after and in the direction of a strong one-directional multi-day move, typically ending the short-term trend. Ideally, they are gapping far away from or into the 21 EMA and or into an area of prior support or resistance. They typically bring in high volume. So let's take a look at those three. And again, it's not so much understanding the definition of what these types of gaps are. It's really about how they trade and what they look like. So let's start with the continuation gap. So what we have here is a stock, and we're going to look at the example to the left. Stock in an uptrend. You have a stock above a rising 21 EMA. You can see the 21 EMA at the bottom of the screen, that red line that's upsloping. You have a stock that is rising in price, and you have a close. You have a stock that closes here and then opens the next day higher. It's continuing the current trend. Exact opposite on the right, you have a stock in a downtrend below a 21, below a declining 21. Again, that's key here. I know it's a subtle little thing, but stocks rising above a rising 21 are stocks that we consider uptrending. Stocks declining below a declining 21 EMA are what we consider downtrending. Now, like I said to start the presentation, there's going to be a lot of information here that isn't supplied that we also consider when we look at gaps outside of just a gap up or a gap down. It's where is the stock in relation to the 21? Is the 21 EMA rising or declining? So on and so forth. And that's stuff that's taught in our active trader class. So here's some not live, but examples of some daily charts, candlestick charts that we use. Again, the red and blue lines that you see on the screen are the 8 and 21 EMA. The gray line towards the bottom of the screen in the chart is the 200 EMA. So we're looking at our 3 key moving averages. The picture to the left, you see a stock that is rising, making higher highs and higher lows above a rising 21 EMA, which is the red moving average. So you see an uptrending moving average, an uptrending stock. An example of a continuation gap. The stock gaps open above a prior day's high, continuing the current trend. And you can see in that picture, that gap up leads to another move higher. Strong uptrend, small gap, over resistance, continues the current trend. You can see that in the candlesticks, again, this is the picture to the left. We have, let me see if I have some tools here. Here we go. Okay, so I'm going to get the arrow out. You can see the stock breaks out above resistance, closes the day strong, the next day gaps up, and the trend continues, a continuation gap. The picture to the right, we have a stock below a declining 21, making lower highs and lower lows, closing the day, breaking support, and gapping down. Examples of what continuation gaps will look like. They will continue the prevailing and current trend. So what is a professional or a reversal gap? This is generally where a stock will change direction due to a gap overnight. These tend to be a little trickier to trade and can catch a lot of traders off guard. So you have a stock on the picture to the left in a downtrend, 4 days down, closes the day, again, where's my mouse, closes the day weak, current downtrend, and it gaps open a professional or reversal gap that basically takes the stock all the way back and eliminates the current downtrend. Notice what took 4 days to go down is eliminated by a gap open, and the stock reverses its course. Prior day close here to the right, stock rallies, strong uptrend, gaps down. Okay, this is what we call chaos. The gap causes the charts to change dramatically. What happens is all the traders in the picture to the left are essentially on the short side. The stock gaps so far up that it causes the shorts to cover and new money to get put to work, and reversals occur that way. Here's an example of what those reversal gaps or professional gaps look like. Like I said, they're chaotic. So here in the example to the left, you have a stock that begins to break down. The gap up erases the big red bar. You can see this big red sell-off bar. Obviously, if you're in this, this becomes a trend changer. Then we get a professional gap that takes the stock back above the previous high and causes that up move. Very difficult to trade, not for a novice trader. Also very difficult to identify. Here on the right, you can see the stock begins to rally up. We have a little bit of a bounce, up, up, up. The gap down causes the stock to go lower. So where everybody was buying it over here and over here, they're now underwater, and it causes the stock to rapidly decline. And lastly, as an example, and again, these are all just sort of generalized, broad stroke looks at gaps, and then we can talk a little bit more in depth about how to trade them. Lastly, you have a novice gap. Now, these are my personal preference to trade. I generally have very good success with these, and again, it's not about being able to trade all types of gaps. It's about understanding how gaps work and what works best for your personal trading strategies, risk tolerances, and risk profiles. Now, in a novice or an exhaustion gap, basically what we're looking at here is, again, it's a reversal type of trade, after a multi-day or multi-week uptrend. Notice in these slides, the ones on the left, you have a stock on a multi-day run. The 21 EMA, which is way down here, you have an uptrending stock above a rising 21, but the stock becomes so far extended off of the 21 EMA that it causes a reversal to occur. So you can see
Evan, you want to just tell people what the EMA is? We got a lot of questions coming about that.
The EMA is the exponential moving average, the 21-day exponential moving average.
Thanks.
Okay. So you have a price gap that breaks away. Looks like a continuation gap. You have a trend. Stock is gapping up, continuing in the direction of the trend, but starts to reverse course intraday. Again, a downtrending stock, way off the 21 EMA, and we'll take a look at this. The gaps down, continues the trend, but as the day starts to go on, the stock starts to trade up. Okay? And these are generally signs of exhaustion. The stock is tired. The stock has rallied so far that it needs to rest, and the gap up creates a reversal for the stock, for people to take profits on their long side and sellers to come into the market. Okay? So think about it like the stock is tired. It just ran a marathon. It needs a rest. The rest is essentially the gap, and the gap up or the gap down, depending on the situation, tends to reverse in price. And we'll take a look at that. Now, in these slides, again, the key here with an exhaustion gap is separation off of the 21 EMA. Generally, you're going to see these types of trades when stocks rally far off of their 21 EMA, which is the red moving average in the slide. Notice here in the picture to the left, you have a multi-day rally and gap up away from the 21. So the stock closes here. The next day it opens here. This is the gap open. Trades up slightly, but then seems to reverse course. Notice how far off the 21. The 21 is down here, and the stock is up here. Separation off the average generally will cause that exhaustion type of gap. The picture to the right, multi-day decline, and you have support. If we look to the left, you can see an area of prior support. What was resistance here and here breaks out. When it pulls back, it acts as an area of support. The stock gaps down into support and begins to rally. So you have different types of looks at exhaustion gaps, but they always occur after multi-day or multi-bar moves. Notice in the slide to the left, you have a 1, 2, 3, 4, 5, 6, 7-day up move, and in the slide to the right, multi-day directional down move that gaps down into support and begins to trade back up. Okay? So this is where this becomes interesting, because now that we've looked at 3 examples and 3 different types of gaps, let's talk about a bias. Now, with the trading part of this, where, like I said, this is where it begins, tends to get more advanced, is that the execution part. Because traders that are looking to trade a gap generally are going to do it very early on in the day. A stock is going to gap either up or down at the open, and it's within that first 30 minutes that decisions need to be made as a trader about what's best, what course of action is best, if any, be it long or short, for you to trade. So when we look at gaps, we got to understand common misconceptions that traders have about gaps. All gaps tend to be filled. Now, I'm not really going to get into this about gaps, all gaps getting filled, but generally over the span of a stock's lifetime, at some point in time, gaps tend to get filled, and we can take a look at that. A gap up is bullish and a gap down is bearish. That is a misconception. Gap ups are not necessarily bullish. Gap downs are not necessarily bearish. It's all in relation to where the gap happens with the current structure of the chart. So gap ups that break away from a 21 period moving average aren't necessarily bullish. They can essentially reverse course and become bearish, and vice versa. The news helps determine if a gap is bullish or bearish. News is irrelevant. A news may create that gap in price, but ultimately what happens when the market opens and traders evaluate that gap is really what matters most. Traders make their money from the movement of price, not from trying to interpret headlines. So let's look at something we put together, which is the gap checklist. And again, I'm going to continue to say it, that this is an advanced topic. So if it's not necessarily understood right here, right now, that's to be expected. This is something that, again, we teach in the latter part of the advanced trading, the active trader course. So we ask ourselves a couple questions in the morning. If you're looking at a stock and it's gapping up or gapping down, this is a good way to sort of evaluate and rate the gap. The higher the rating, the more likely you are to want to trade that gap, and so on. So is the stock gapping over? And again, these are questions that you should write down or revisit, if you're looking to trade gaps. I will say this, that if you are looking to trade a gap, whether it's a continuation gap that continues a current uptrend or a reversal gap that reverses a current trend, understand that these types of trades happen early on, and they tend to be sometimes very fast. So it's our recommendation as educators to say that this is something not necessarily built for a novice trader day one who's just sort of, getting their feet wet with technical trading or active trading or day trading or what have you. This is something you probably would want to put into your trading tool belt somewhere further down the line when you're more comfortable with price action, technicals, speed, the way things move, making decisions, analyzing risk. So is the stock gapping up or over, gapping over or under daily support or resistance? Ask yourselves these questions. And the answers are always going to be yes or no. What has happened on the daily short-term pattern? Has anything changed? Has anything about the gap changed the overall dynamic of what was happening yesterday, the day before that? Does the gap have relative strength or relative weakness in correlation to the broader market? So let's say you come in and the market is gapping down, the S&Ps are down 10 handles, but your stock is gapping up $1. That would show an example of relative strength. You correlate basically your stock's gap to the gap of the overall market. If you come in and the S&Ps are basically flat on the day, there's no change, but your stock is gapping down, 5% or $3 or whatever the gap is, you have to look at that and say the gap is relatively weak with correlation to the broader market. Is the size of the gap average or is it excessive, and does it destroy the technical pattern? Now, question 4 probably comes with a little more experience, as generally, if you're trading let's say a $50 stock, and you come in and the stock is up 25% overnight, and it's up, $10 or $12 overnight, that's an excessive gap, and that does dramatically change probably the landscape of the technical structure. So you have to be able to evaluate, is this gap excessive? If you're trading a stock, let's say like Apple, that's $550 in price or whatever the current price is, and you come in and the stock is gapped up 50 cents, that's not an excessive gap. It's actually a very small gap. So we award points according to our checklist. The more points awarded to the bulls, the more bullish the bias, and vice versa. A 3 to 4 star gap are the only gaps that create a strong enough bias to determine if the odds are favorable. Anything less than 3 stars is best left alone in regards to playing the gap as a strategy. So not all gaps do you want to trade. You only want to trade gaps that you can evaluate, that have substance to them, that you can understand, and fall into the higher rating in our checklist. So a stock is over or under support or resistance. So a gap up over resistance, 1 star to the bulls. A gap under support, 1 star to the bears. Short-term pattern. Here we look at the gap in relation to the last 1 to 3 days. Okay, we're looking at how it impacts what has just happened in the short term. If a strong bullish prior day's bar is erased 100% at the open, so stock has a big rally today, tomorrow you come in and it is gapping down and erases everything that happened yesterday, this can spark a snowball effect move. The stronger the prior day's bar, the greater the spark. Okay, and again, I suggest going through these slides again and rereading them so that they start to sink in. If your expectations are that you're going to attend a webinar and you're going to learn it, and it's going to sink in, and it's going to make sense, and you're going to be able to do it, chances are your expectations are out of line. That's not the reality of how this works. Stuff like this, trading gaps, again, this is just one sliver of a strategy of trading, takes time to develop. This is about learning a process. So a gap up over a solid bearish bar, 1 star to the bulls. A gap under a solid bullish bar, again, so these are reversals, 1 star to the bears. Then we look at the relative strength, relative weakness component. If the market's gapping up, if the market's gapping down a considerable amount and the stock is gapping up, relative strength, 1 star to the bulls. Vice versa, 1 star to the bears. So if the market's opening flat or neutral and the stock is gapping a significant amount, again, notice the word significant, more than usual, 1 star in the direction of the gap. If it's gapping up, it will be 1 star to the bulls, gapping down, 1 star to the bears. If the market and the stock are gapping in the same direction, half a star in the direction of the gap. If the futures are up big and your stock is up big, half a star. So let's talk about rating the gap and, again, the size of the gap. Ideally, the stock should be gapping just enough to create the spark. We're looking for the gap to become a tradable event. That tradable event is what we call the spark. Generally, just enough to erase a prior bar and or prior support or resistance. However, if the gap is erasing a significant wide range big body bar, the more the better. In this case, it only becomes excessive if the gap erases the prior bar and support or resistance excessively. A novice, the exhaustion gap, has exception to size, as the greater the size of the gap, the better, as long as it does not become excessive. An excessive gap is one that destroys the technical pattern of the chart. Again, much better explained in a visual medium, not necessarily reading a paragraph. So if the size of the gap is just enough to create a spark, then it's 1 star in the direction of the gap. And our tip, if the size of the gap is excessive and destroys the technical pattern, then all ratings and gap strategies are considered null and void. If something, and you'll see this a lot with earnings, if a stock, was strong the last 3 days, comes out with earnings and is down 30% at the open, chances are that makes everything null and void. So when the landscape is dramatically changed, all bets are off, as the chart is what we consider broken. The only thing that heals a broken chart is time. So we're going to look at some ratings here. So a novice gap, again, that exhaustion gap, that's when a stock has rallied or declined for multi-day and gaps up and then starts to reverse, again, part of a reversal. But we do this one slightly different. Rather than awarding points in the direction of the gap, novice gaps are awarded points in reverse or opposite of the direction of the gap. So question 1, is the stock into support or resistance? Question 2, what has happened on the daily short-term pattern? 3, does the gap have relative strength or relative weakness in correlation with the broader market? And again, you can see below how we award the points. Is the size of the gap average, or is it excessive and destroy the technical pattern? Ideally, it's the biggest gap possible without being excessive. Let's take a look. Here's an example of a 4-star novice exhaustion gap. The stock is into resistance, which would be to the left. I mean, historically, it's not shown here in this image, but the stock is into resistance, 1 star. Short-term pattern, 1 star. When I say short-term pattern, a multi-day directional move off of a rising 21. Relative strength, the market is gapped up, which we can't show here. And the size of the gap, 1 star, again. So this is a 4-star gap for a novice or an exhaustion play. The key here is for the trader to acknowledge resistance to the left, which again is not shown, and the type of gap that this is. Evaluating this is an exhaustion gap. A lot of times Again, especially in earnings season, you'll see this where a stock, and for those of you that aren't familiar, take a look at LinkedIn, symbol LNKD, after it reported earnings. Gapping up into 120, 120 on the chart. If you look to the left, was the high previously from the IPO. And within a matter of 3 days, the gap had been filled. An exhaustion gap. It was in a multi-day up move, gapping up into earnings and selling off. You're seeing a lot of that. Here's a 3 to 3.5 star professional or reversal gap, where the arrow is down here. The stock, multi-day down move, closing here on the lows. The stock gaps up, again, professional or reversal gap, gaps up above prior, again, what would be prior support, resistance, gaps up above that, completely changes the prior day, completely eliminates this big down move, and causes a reversal. Okay? Notice in the reversal, it trades back to the 21 EMA, which is the red line. The 21 EMA is probably our most important moving average and can sometimes act like a magnet for reversals. Okay? These are difficult stocks, difficult gaps to trade because you come in with a bias because the stock has been downtrending and ultimately it changes on a dime. Now, different entry techniques or strategies to buy or sell gaps. And again, there's not an exact, it is best practices. Different traders do different things with different approaches. We're only looking at a small sliver of some approaches here. 3 or 5 minute high low. This method works best for stocks that show heavy strength or weakness off the open. If a stock has a 4-star bullish gap, traders will wait for the first 3 or 5 minute bar to print. Once that bar is closed, if the very next bar trades above the prior bar's high, the bias is validated and the stock can be entered with a stop under the low of day. So you are essentially buying a 5 minute high or selling a 5 minute low. The second methodology is the first buy sell setup. The method works best for stocks that don't see heavy conviction off the open and retrace a part of the gap first before continuing in the direction of the bias. If a stock has a 4-star bullish gap and off the open retraces a part of the gap and forms a, what we call a buy setup, traders will look to enter on the trigger of the buy setup with their stop under the low. If you're not familiar with what a buy setup or a sell setup is, again, another part of our active trader course that we teach for entry and usually correlates into rising or declining moving averages. Again, a copy of the presentation can be sent to you if you text your name and number to that phone number. And with that, I'm open for questions. And if I can bring up my charts here, let's just see if I can bring up my charts. Mike can probably help moderate some of the questions.
Yep. So we got a couple questions, Evan, on the SMAs and the EMA. And the first one being, you kept referring to the 21 period, and is the 21 significant over or more significant over other periods?
It's not that it's, again, with trading there is no exact. I hate to speak in generalities. It's not that one is more important than the other. It's about having an approach that you know works. So a lot of times, and again, the whole EMA conversation can go a lot deeper. You know, there's a significance to why we use the 8 and the 21. I really don't want to get into that here now because it could take another 30 minutes. But it has to do with harmony, and it has to do with some Fibonacci concepts, which is all about symmetry and harmony in the markets. For those that are active in short term, meaning those of you that are looking at day trade or swing trade, somewhere in the intraday arena to 2-week arena, the 21 EMA is a very good benchmark indicator for both trend as well as price. And that's really the best way I can put it. You know, I think most traders do things conventionally. They look at time frames that are what everybody looks at. Traders look at 5-minute charts, 15-minute charts, 60-minute charts, daily charts. We teach our traders at T3 Live to not do things conventionally. We alter our time frames, we alter our moving averages to create a little bit of edge that necessarily you wouldn't have otherwise. Again, you can always email me at evan@t3live.com. I can try and provide more color, but the 21 is really, really a staple for short-term traders.
Yeah, so maybe that kind of answers my next question here from our audience, which is, you know, I think most traders are used to using the SMAs instead of the EMAs. So do you guys feel at T3 that the EMAs are more relevant for day trading? Or
yeah,
why?
I mean, the reason that we use an EMA and not an SMA is because of the way they're calculated. Simple moving averages are calculated an average price over a certain amount of time. Exponential moving averages are calculated a price over a certain amount of time. However, it weights forward price more heavily than historical price, whereas an SMA looks at price as just price, and they're not weighted any different whether they're recent or historical. Active traders are focused on the here and the now, so EMAs are a better, in my opinion, a better moving average because it will weight forward price more heavily than historical price.
Okay, got it. Let me see what other questions we have coming in. Do you guys think that are the gap trades mostly for day trades, or are you also using them for multi-day swing trades?
Well, they can be used for either or. So I have my chart up here, and the reason I did is because I thought we would take a look at some of those. And again, this is just one that pops out into the sort of current in my mind. LinkedIn from a couple days ago, you had a what we would consider a reversal gap, a stock that is gapping up off of the 21, and you can see that gap up creates a reversal in price, and the stock trades all the way back to that rising 21 EMA, or that general area. It's not about the exact price of the moving average, it's just an area, and it trades back to that 105, 106 level, which for those that were, you know, participating in our VTF was a very, very good profitable swing trade within a matter of 2 or 3 days. Great example of something that gaps up post-earnings that reverses price. Perfect example of an exhaustion gap. So, again, that's kind of an example of what we're talking about here.
Okay. Do you ever find you guys, are you running into any issues with the uptick rule when you're trading the down gaps? Is it harder to enter the positions?
No.
Okay, that was simple.
I mean, there's really no other way I can answer it. It's you know, at some point if a stock gaps down, it's going to give you an opportunity to get involved. Might not be the exact penny you want, but at some point, you know, if you're nimble enough, you'll be able to get involved.
Yeah, I mean, I think the important point is that you're not looking to enter the trade on one specific tick. If the first tick is down, you just wait for the next one for your next uptick.
Correct.
Okay, let me see if we have any other questions here that you haven't addressed. So this one's probably hard to gauge, but is there a rate of success that you can talk about on trading the four-star gap?
I don't have any statistics to back it up because I don't have a way to look at every single gap across the board and rate every single one. I think it would probably be impossible. But I think if you are an experienced trader, someone who knows the content and the material well enough, stocks that generally give you a 3 or 4-star gap become much higher probability short-term trades. So it's really a question of, okay, A, you know, is my stock that I'm looking at gapping up or down? B, you know, how does that gap affect what's happening? C, is there any decision in terms of a trade that I need to make here, you know, off of this gap? You know, I can show you another example that I think makes a lot of sense. Again, we'll look at Apple. as an example here, let me remove the lines. But you can see here a couple days ago we have this gap in price. You see where my mouse is, the stock gaps down. It continues the short-term trend. This is a continuation gap, and right from the get-go, below a declining 21 EMA, again, see the 21? So traders knew that when we gap down, chances are, because we were below a declining 21 EMA off of a short-term downtrend, that this would ultimately become a continuation gap, and you get another day and a half, gaps down again. This time the gap reverses right into the 20, right back to the 21. So it gives you a nice short-term day trade if you're cognizant of what you're looking at. So really the key here is understanding, how the gap affects what's happening in the near term, and does it change the structure of the technical landscape. Like I said to start the presentation, this is one piece of a wheel. Gaps in and of itself it's great to know the material, but you have to know other material in addition to this to supplement that decision-making process.
Okay. And are you setting up stop losses when you're trading these gaps? And if so, are they any different than stop losses during any of your other types of trades?
No, a trade is a trade. Whether you're trading off of a gap or you're trading a stock without a gap, a trade is a trade. Every trade needs to have risk. Like I said to start, we're risk analysts. Like I said, I'm much more of a risk analyst than I am a trader. Yes, I know that probably doesn't make a lot of sense because I trade, but that's really how I view myself. So I always set a stop. Whenever I buy or sell a stock, the next action that occurs immediately after that buy or sell is that stop order. I put in hard stops. I trade with hard stops, period.
Okay, sounds good. Let me see what else we got here. So we have a question from someone about intraday gaps. Do you ever see those, and do you treat them any differently than a gap at the beginning of the day?
Intraday gaps are pretty infrequent. Generally, stocks that are going to gap intraday are going to be very, very illiquid instruments. I generally, for those that have participated in my active trader course, you'll know that we generally don't look to trade illiquid stocks. Stocks trading, let's say, under 200,000 shares a day, because for us, execution is key, being able to get in when you want to get in, being able to get out when you want to get out. If you don't have the ability to get into a position or out of a position, or it's going to gap intraday on you, it's probably an instrument you probably don't want to trade, as it's going to take, you're probably taking on more risk than you realize. So it's very infrequent.
All right.
That I would see that.
And Evan, maybe you could put that slide up again with the phone number that people can text to get a copy of the slides.
Yeah, sure.
And then
this is not my cell phone, FYI.
This is your personal cell number?
This is my personal cell number. Text me anytime.
So only call after 10 p.m.
Please.
Okay.
646-490-1819.
And then also along those lines, just getting a lot of questions about recording the webinar. So yes, we are recording it. It will be posted on our website, lightspeed.com/webinar is where you can go to all the past recordings, and we'll have this one up hopefully sometime tomorrow afternoon. So on that note, I think we'll call it a day. Evan, thanks again for a great presentation. Thank you to our audience for all the questions you've submitted, and we hope you've enjoyed the presentation. And we'll have Evan back on with us soon. So
Thanks, Mike.
Thanks, everyone, and have a great night. Thanks, Evan.